In this video, we're going to be talking about AVCT, American Virtual Cloud Technologies. In the modern economy, computers are increasingly important for businesses, for companies to thrive and to make profit. They constantly need to be faster, smaller, and more flexible. Of course, this is not just for companies. I myself am constantly looking for smaller, more flexible solutions to either play games, render videos, to do my job, and so on. One of the solutions is to favor increasingly virtual working environment. For example, my daily job is mostly done on a server, on a remote server. I can technically use any computer to reach it. That seems to be the trend that has been going on for the past 5 to 10 years. And American Virtual Cloud Tech definitely saw that trend and then decided to go for the digital gold rush as well. They probably went public with a SPAC, looking at the historical price, and then they expected that, once they finish the merger, everything is going to be great, and then they're going to take off. They took off, but the other way around, because 2020 arrived. Unlike a lot of companies that were temporarily disabled by March 2020, for those of you who remember, the market was almost going through like an Armageddon phase back then, right? They took a gigantic hit, but then very quickly recovered. Is that the case with AVCT? No, never. They never seem to have recovered ever since then. They took a massive hit. They regained some of their former losses in 2021 and 2022, probably because when everything goes up, even the worst ones kind of go up, right? But that kind of stuff never really lasted. To be honest, they actually tried. They actually tried to conduct like a legit business. Well, legit business. They actually tried to just conduct a good, profitable business, right? To hopefully prop their stock price up with fundamentals. But the sector has a lot of big sharks, hungry for customers, and more importantly, whatever monthly subscription fees that those customers can spare. And to be honest, consumers in that sector tend to go with more established players. Because here's the other thing. I once subscribed to a cloud gaming platform. It was really fun. It wasn't very stable, and I'm pretty sure that no longer exists. Last time I checked, they've switched whatever they serve to the customers. So I think that they're no longer into gaming cloud computers. But see, I'm just an individual. I don't really mind the fact that this cloud computer platform doesn't really exist anymore, as long as I get my refund or as long as I've used up all my credits. But the bread and butter for this industry seems to be mostly companies, businesses with employees. They can play around with the fact that, this kind of company might go bankrupt one day from the other. And this is also why, smaller cloud computing companies, either they're very niche, so they serve one or two clients and their business model is built around it, or they're going to have some hard times gaining the trust from the potential customers. Because if I have my employees there, if I've installed all my, softwares, if I start to actually rely on this company, what if this company just goes bust one day from the other? What if I read on a Saturday morning or on a Sunday morning, whatever, that this business is now up for sale, which, by the way, is the case for AVCT at the moment. Recently, there was a massive change in the business orientation and the strategy of the corporation. They have decided to sell part or the whole business. And this, in my opinion, has gathered a second wave of interest in AVCT. Because if they sell it to the highest bidder, maybe the new bidder is rich enough to give a bit of, premium for the shareholders who, I mean, this is going to be a little bit heart-wrenching, but if you've been holding AVCT since the day the reverse merger was completed, then props to you, because you really have a lot of a very big bag. Let's put it that way. So, can the shareholders get a premium upon the sale? That's possible. But even if the terms were not that great, that is not really the point, right? The main point, in my opinion, is can this volatility, this expectation, whatever thing that there is, can this favor shareholders? Can shareholders benefit from like a sudden uptick in the stock price? From what I'm looking at right now, it seems like the stock price has been bottoming out and is now slowly regaining its momentum. Nobody knows whether this is going to last, but see, I think that after such a dramatic period of time for that stock, which isn't that long ago, but like basically, if a company has been going through that many, disappointing periods of time, I feel like at some point, any news might be a good news. Of course, absolutely don't quote me on this, okay? But I think that whatever volatility that there will be, if any, for AVCT coming down the pipeline, it's probably going to be more good than the other way around. Now, there was also like this rumor that maybe Microsoft is going to buy AVCT. Look, at this point, I would treat it as one of the possible scenarios, right? And if they're bought by Microsoft, then the thing that we can guarantee is that, well, Microsoft is going to pay whatever they promise to pay. The question is how much they're going to pay for AVCT is another question. And to that, I'm afraid that nobody truly has any sort of guaranteed answer. Or if they're guaranteeing, we should be asking ourselves if that person is any trustworthy. Okay, so this is what I think about AVCT. The ups, like I've said, it's the expected volatility. The down, well, what if a sale takes a long time? And what if people are disappointed by whatever outcome? And also, because this is a small company, a small raft in a big ocean, sometimes things are not that easy. But seriously though, if you treat the stock like a box with different scenarios, and if you place down how much you want to risk per scenario, right, I would say that this is definitely a go. Okay, the price action looks like it's been down for so long, for so much, that there's really not that much room to go down further. And regarding the fact that it's a small company, this will mostly dictate whether we want to hold on the stock for a long period of time. Now, the other benefit for owning AVCT is we don't have to ask ourselves this question, because it's not going to be a stock that you will be holding on for years to come. I have an unrealized loss of about 35% on my Palantir position, right? I might have to hold it for years. I have about like 40 or 50% of unrealized loss on my SoFi position. I might have to hold for a few years, which, by the way, I don't mind holding, because I think I have like 0.1 to 0.3% of my portfolio in both of those titles. So AVCT, I think that as long as you're willing to risk whatever you can spare to lose, or the amount of money in such an amount that if everything goes to bust, the rest of your portfolio can get it back to its feet. Or if your portfolio will not be affected in any way whatsoever if the company goes the other way, meaning down, then it's gonna be a pretty interesting option to have as a secondary or tertiary or a marginal position. Now, how much should you be holding? I think that between 0.1 and 0.5% is like the maximum here. I'm sorry if I'm not one of those people who risk 10% on small cap penny stocks, but I've been there where a lot of people were significantly burned by it and their portfolio hasn't made it back. Because you have to remember, opportunities up, like massively up or massively down, there will be a lot of it, right? But you only have one portfolio. Your money, once it's gone, it's not going to come back just by itself. It's not going to grow 2 feet and crawl back. Well, in this case, not crawl, but to walk back into your wallet, right? So this is why we should be careful with companies like AVCT. There is an opportunity that the sale might go well, that somebody is going to dole out a lot of cash for it, but don't put too much hope on this kind of optimal scenario, just because one, you should never do this, and two, think about what is the current quantitative situation. Are governments around the world printing money like there's no tomorrow, like what they did back in 2008? They don't seem to be doing that, right? So this is why I would say 0.1 to 0.5 is the maximum that I would recommend to put into AVCT. If after watching, YouTube videos, people's opinions, or doing your own due diligence, you've decided that, oh yeah, you know what, it's actually legit, so I'm gonna buy this company. Yeah, I would say that the maximum exposure should be 0.1 to 0.5%. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, a I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.